All right, perfect. So thank you very much for joining. We're super happy to have you here. This is our first webinar from the Into the Block team. We're gonna be doing these webinars periodically, and every time we're gonna bring you new insights about the crypto assets market, about some of the new things that we're discovering using our platform. At the end of the webinar, I'm going to announce the next one that is going to take place in about 3 weeks. My name is Jesus Rodriguez. I'm one of the co-founders. I lead technology and research for Intotheblock. I have a background as a computer scientist with tenures at companies like Microsoft and also in Wall Street. I've had several exits as an entrepreneur, and I'm an active investor in the space, but more than anything, I'm obsessed with data science and blockchain. So a few months ago, we decided to incubate what is today Intotheblock, a project that sits at the intersection of data science and crypto technologies to use cutting-edge machine learning techniques to bring you new insights about the crypto asset market. A few logistics about the webinar. At any time, feel free to use the Q&A panel. We have people that are monitoring that actively, and we can stop for. We don't need to wait until the end. I'm gonna switch over to to the slide deck, and then we'll get back to the video. So as I said, today we're going to be talking about, it's our first webinar about data science for crypto assets. Specifically, we're going to be talking about why crypto assets are what we call a data science heaven, are a very ideal environment for data science. What exactly are we going to be covering? Today? We're going to be talking about the first part of the presentation. I'm going to try to brainwash you and convince you why crypto is a new asset class with new fundamentals that requires a new form of analysis. Then we're going to introduce this concept of crypto asset fundamental analysis as a methodology for understanding and drawing getting new insights about crypto assets using data science. And finally, the second part of the presentation, I'm going to give you some very practical examples about the crypto market that are, I'll say, that are going to shock you, are going to challenge some of the fundamental belief. You believe some things about crypto assets, then we're going to show you what the data is telling us, and some of those things are going to be in conflict. There is a lot of ground to cover, so I'm going to go a little bit fast. As I said before, feel free to use the Q&A panel, and we can stop for questions at any given time. So let's start with a very, very obvious statement. Crypto is a new asset class, and as a new asset class, it has new fundamentals, and with new fundamentals, you should have new methodologies, new techniques for analyzing and extracting insights and ultimately predicting the behavior of crypto assets. Now, what I'm telling you might sound obvious, particularly if you live in the financial markets, because at the end, every other asset class in history have brought unique factors that have influenced the methodologies and the techniques that we use for extracting intelligence about that asset class. So with the stocks, we look at factors such as price, volume, momentum, and things like that. Currencies brought us 24/7 trading. Commodities are mostly dictated by dynamics between supply and demand. In the case of bond and debt products, we look at things like risk and dividends. So crypto is not different and has very unique factors that makes it unique, and therefore the analysis should be different. So what exactly makes crypto unique? Well, let's look at some statements that you might have heard in the past. Crypto markets are irrational. That's true, right? The theory, Eugene Fama's theory of efficient market hypothesis doesn't play in crypto just yet. Crypto is not correlated to other asset class. We have seen many futile attempts to correlate crypto with gold, commodities, Chinese yuan, and it's really hard to extract any meaningful relationship. crypto assets are constantly vulnerable to hacks, to cybersecurity attacks, and those things really influence. I mean, when was the last time that you heard a cybersecurity attack on an Apple stock? But in crypto, it happens all the time. So if I tell you what are the things that make crypto different, you might be inclined to list some of those factors. Well, that's complete nonsense. The only two things that matter that make crypto different are, one, you can use it to build decentralized applications. You cannot build applications on top of a Facebook stock, on top of a US Treasury bond, but you can build applications that use Ethereum as a fundamental infrastructure. The second one is that crypto assets is the first asset class in history that records a behavior in public ledgers, which is an information goldmine. So the first factor is really not very relevant to predict and understand the behavior of crypto assets, but the second one definitely is. So from that perspective, so if we factor in the idea that crypto, the behavior of individual investors manifests somehow in some form in public ledgers, crypto might be classified, might be considered the richest class in history. So it brings a universe of data with on-chain data set that we don't have access in other asset class. And it's the first asset class in history in which the behavior, the patterns, the tendencies of individual investors is publicly available for analysis. But if crypto is so different, why do we insist in going back to the same old techniques? We still try to apply technical analysis techniques, some fundamental analysis methodologies to try, not that those are invalid, but ignoring the unique factors of crypto just doesn't seem like a great idea. Well, we were thinking about this, and look, there is a theory in economics that sort of tries to establish a relationship between the transparency, the level of transparency that you have in a market, and the complexity of the analysis methodologies that we use. For instance, it sort of goes like this, right? The more complex, the more transparent a market is, the simpler the analysis methodologies that we should use to understand it. It's not a surprise that markets such as derivative has like an incredibly complicated analytic methodologies, because nobody really understands how that works. So if we extrapolate that to crypto, well, crypto is a market in which the behavior of investors is recorded in public ledgers. At least we have that option. So the analysis methodology should be simple, should be human relatable, should be things that most people understand. And yet we insist in doing stuff like this, right? Of trying to apply the same type of methodologies that we use for other asset class, try to extrapolate it to crypto, ignoring everything that makes crypto unique. Again, this is not saying don't do technicals. I mean, there is a value, there is a place for technical charts, but it's just not the complete picture. Analyzing, trying to be a little bit more direct. So analyzing crypto assets with just price and volume and ignoring everything that happens underneath is just being lazy. But more than being lazy, it's also ignoring the richest data asset that you have as an asset class. So here's the idea. Crypto asset requires a new form of analysis, something that complements the existing analytic methodologies in the market. So how would that look? If I give you a pyramid, so if we put blockchain as a first-class data citizen of crypto, as the fundamental data class that we're going to use, we put data science on top of that. We use machine learning, advanced statistic techniques to try to extrapolate nonlinear relationships between data points in the behavior of crypto assets. We should be able to come up with indicators that anybody can understand, that you don't need to be a chartist, you don't need to be a technical analysis expert to understand it, that anybody can relate to it. So that's an aspirational goal, but definitely the foundations are there, and that's what inspired us to create Intotheblock in the first point. It was the idea of, using cutting edge. We're in the golden age of data science and machine learning. We have the richest asset class in history in front of us. If we put those together, we should be able to simplify, to democratize, to streamline the way we understand this asset class. How would that look like? To try to be a little bit more practical. Well, if I ask you to describe Bitcoin to me, or to describe Ethereum to me, you're gonna use not one characteristics, you're gonna use several. Some of you are gonna talk about price and volume, and that's financial behavior. Some of them are gonna use expressions like a lot of people are making money with Bitcoin, or losing money with Ethereum. If you're a little bit more technical, you might be inclined to talk about the network. Crypto assets runs in network. What's the composition of that network? Is it big? Is it small? Is it growing? Is it shrinking? As any asset class, the most important characteristics when you're trading is to understand your counterparty. Who is on the other side of that trade? That's practically impossible to do in traditional markets, but in crypto you have a shot, because the behavior of individual investor is somehow available in some statistical form that is relevant. Also behavioral. So now that I know who my counterparty is, what's their mindset? Are they confident? Are they happy? Do they follow trends? Do they create trends? So try to understand the psychological profile of that investor. And also social. Is this an asset that has an active participation in social? Is the sentiment positive? Is it negative? So you don't describe an asset in one dimension, you describe it in many, and those many dimensions are the same one that we should use to analyze that asset. So if we put all that together, if we put data science, looking at blockchain data sets, and try to extrapolate patterns, what can we find? And that's the Intotheblock platform. We created this massive platform that analyzes the top blockchains in the market, near real time, injects data from all sorts of other data sets like GitHub and LinkedIn and Telegram and Google, and also alternative asset data sets, and runs a number of machine learning models on top of it to extrapolate unique signals that you cannot find anywhere else. And the initial set of results have been fascinating. So I'm not gonna pitch you the product, I'm gonna show you some things that are probably going to shock you, and at least challenge some of the fundamental beliefs that you have about crypto. So if I ask you, very simple question, how many people are making money with Bitcoin? There have been price rallies and corrections in the last few months. So if we're on probably 50% of the all-time high, so how many people would you think that are making money with Bitcoin? An intuitive answer would be, well, about 50%, about 60%. It's too bad that we're not in a live audience, because I like to play these games of question and answers with the audience. But we run an analysis that is called the in and out of the money. It borrows some principles from options trading, in which we actually try to use some machine learning to try to extrapolate, to partition the entire blockchain into the groups of investors that are making money or losing money based on the historical trades. It's a very complex and expensive computation, but this is what it looks for Bitcoin today. So about 80% of the Bitcoin investors are making money, are in green. So those clusters, those circles represent different groups. The size is the number of addresses. You have the price. The gray circle represents the ones that are at the money, the ones that are closer to the price. And there is only one group, the ones that are between $10,000 and $19,000 that are losing money. When you look at this, well, you see an optimist group. You see that the spirit in the Bitcoin investor base is positive, right? People are making money. You also can think that the next price movement is gonna between 9,700 and it's gonna have to go to around 10,400 to have some activity, because that's a group that that's the lower end of the group that is out of the money. So it gives you some ideas of, if the price move up or down, what am I playing with? Now, I'm going to ask you the same question for Ethereum. So we heard this before, right? Ethereum and Bitcoin move together. Bitcoin drives the rally for the altcoins. So it's only logical to think that Ethereum has a similar composition. Not in a million years, right? The same analysis for Ethereum reveals that only 27% and change of the Ethereum holders are making money. So Ethereum has a lot of walls to climb. It has a difficult road ahead in order to get to an all-time high. We run different analysis that sort of tells how that rally might happen, but those are not in the presentation. But if you're only looking at this picture, it's not as rosy, right? There is a lot of people in the red that need for the price to increase to be active. So a hypothesis here is that the next price movement on Ethereum might be fueled by new money coming in, because this money, in this picture, there is a lot of people that are out of the money, as you can see in all these red circles. So let me ask you another question. So stable coins, they're supposed to be pegged to fiat currencies such as the Swiss franc or the British pound or the dollar, and they're supposed to move in a very close proximity to a fiat currency. So conceivably, it's almost impossible to lose money with a stable coins. That's not true. So we run a different analysis that it's called the break-even analysis, that tell us where does the price has to go in order for groups to recoup their investment. This is super important because it tells you when the price moves, what's a level that it has to achieve for certain clusters, for certain groups of the population to participate, to trade. If not, it's not important to them. So, and when we look at DAI, you can see that there is a group here that the price has to go to $9.5 for those investors to recoup their investment in a stable coin that's supposed to move to close proximity to $1. I mean, that's unheard of. That's crazy, right? So it's never going to get to $9 until a disaster happens. So this is just a definition of a bad investment. And if we look at that picture for the Gemini dollar, it's supposed to be more stable. Well, I mean, there are people that are over $2 in that red. So you can see how this analysis reveals things that are not very trivial to analyze by just looking at price and volume. Whales, here's another interesting question. So whales are large investors. And large investors tend to move the price because they trade. And if they trade, you know, they can dump big positions or accumulate large positions, and that becomes a problem. So looking at whales is important. So let me show you two pictures. Here's a picture with a token that is, they're both smart contract platforms. Here's a picture with a token that is 7% concentrated in tokens and one that is 20%, 28% concentrated. So by looking at this, right, you will say, which one do you like the most? And many people tend to gravitate towards the asset that is less concentrated because it means that the network is better distributed. Well, that's Ethereum, and the one on the right is Ethereum Classic. And two smart contract platforms, complete different distribution in terms of whales. Now, whales are only relevant if they trade. So let me show you a different picture. So this is an analysis that Intotheblock runs that tells you how the whales are trading, what's their trading activity. And in this case, you can see big clusters of high activity addresses that tells you the whales that are actively trading. And in this other one, and the ones in blue are the ones that are not actively trading. And you have the same analysis for the other platform. So if we look at that, many people tend to gravitate towards the one on the left, but it's Ethereum Classic and it's Ethereum. So you might have liked Ethereum from some points, but then seeing the activity like Ethereum Classic. So it's not only how concentrated it is, but it's the activity of those whales. And you can only determine that by looking at on-chain data. You don't get this from looking at order book data. Here's a situation that is far from ideal. This is what you don't want. This is a token that is overly concentrated and with whales that trade very actively. So that means that you're constantly exposed on the other side of the trade. That's a situation of Polymath, one of the players in the security token space. Another interesting question. So is new money coming into crypto asset? New money means price rallies. So if you remember the in and out of the money picture, if a lot of people in Bitcoin are not selling because they already made money, where is the new money coming in? Well, it's from new investors playing and being more aggressive. in the market. So analyzing new populations of investors coming into the market is very interesting, because if you can predict that with certain accuracy, you can understand price rallies. So here's an analysis on Litecoin as of today. And as you can see, Litecoin has had a lot of activity recently in terms of price. And putting a few things together, when you look at the traders analysis, when you look at how the new investors are coming into the market, this is one of the factors that is influencing that price movement. Litecoin has a very healthy flow of new investors periodically coming and playing into the asset. How about the opposite? Is money flowing out of an asset? So you see a lot of analytics platforms, they tell you address count. Is the network growing or shrinking? Well, I mean, that doesn't mean much, right? A big network, you need to try to qualify the participants of the network. So one analysis that we run is, sure, I mean, here the network addresses, but are they trading? Are they active? Are they new? And how many are getting out? And then you plot that over time. This is the analysis of BAT, the Brave browser token, and you can see it's very healthy. They're adding way more users than the ones that are getting out. So the network is growing at a very predictable pace. A larger network means less volatility. It means more stability is important. If we run the same analysis for something that will be not so clear, so you see addresses that periods of time in which the number of addresses that are getting out is larger than the number of new addresses. And this is a behavior even for some of the large tokens. So if we look at Litecoin, we see the new money is healthy. There is also a lot of people getting out. So the network is not growing as healthy as other parameters. So that's a concern. Does trading happen when I'm sleeping? We all have been victims of this, right? You go to sleep, you place a trade in the morning, you wake up, and then the price is, on the other side of the spectrum, and you try to wonder what happened. Well, I mean, what you should understand to begin with is how exposed are you? So how much of this token trades on time zones that I'm not gonna be able to actively participate? Here's an analysis that we run that is called the East versus West. That tells you we timestamp every transaction that we can find, and we use some heuristics to determine whether they're in Asian time zones or whether they're in Western time zones. And we run this analysis at a scale and give you a predictor for the token that said, this percentage Eastern based with this level of accuracy, this percentage Western based. So here are two tokens. They're both decentralized exchanges. The one to the left is predominantly Eastern. You can see the blue bars. The one to the right is predominantly Western. So if you're an investor in New York, you should like the one to the right because you have better exposure to trades. Whether if you're an investor in Beijing, you should like the one to the left. So they're both decentralized exchanges. One is Kyber and one is 0x. And this is two tokens in the same space, completely different token holder distribution. Even when you see in 0x, there is some months like here in which the Asian investments are very relevant. For the most part, it's predominantly Western, and Kyber is predominantly Eastern. So these are some examples that I wanted to show you in which how data science can highlight things, can give you signals, can give you data points that can be very important in trades and are not very easy to determine by just looking at the traditional indicators like price and volume. By not simple, I really meant impossible, right? If we dig deeper into blockchain data sets, if we complement that with exchange data, with alternative asset data sets, and we put data science at the middle of it, we should be able to get meaningful indicators that are human relatable, that people can understand and are conducive, they're actionable, they can generate meaningful trade signals. If we use those indicators on top of and put data science to work with those indicators, we should actually get even better signals that give you more specific actions in terms of a token. And if we put data science to work on top of that and combine it with risk analysis and portfolio management and things like that, you should have very, very cohesive, very, very solid trading strategies. Crypto is an irrational market. The trading strategies are still very nascent and very basic. And in a rational market, good strategies can last for a long time, can be very profitable. They don't tend to correct as frequent as in a rational market. So, but in order to come up with trading strategies, you need to dig deeper into the nature of a crypto asset, and that is the blockchain. So this is this methodology, this type of analysis is very expensive to do. I mean, we run over 2 terabytes of data, incredibly long computation models. The good thing is we did a lot of the heavy lifting, so you can benefit from it, but there are challenges. So exchanges create significant noise. The fact that all the transactions are anonymous, it makes it hard to qualify. Is this a bot? Is this an OTC desk? Is this a miner? Exchanges are notorious for creating volume. So for faking volume and altering the data that they report. So all that is true. We're actually working on this. We have data science for machine learning models that we're training to try to get better at this. And what we have today is not exact, but it's very, very relevant, statistically speaking. There is a question on the Q&A that said, "Are you open sourcing the tool you have been using?" The tools we have been using are all open source. So we build Intotheblock in complete open source stack. Now the platform itself is not open source; it's SaaS based. You can log in and play with it. At the moment, you use our portal or our APIs to access the data that has the signals and the calculations. In the future, we might explore other vehicles to give you more complete data sets and things like that. As of today, we think we have done a very good job in terms of visualizations and experience that you should be able to use. Or if you want a more in-depth integration via the APIs, I'm super happy to talk to you. By the way, Intotheblock is still in beta. We just opened it to everyone, so you can play with it prior to the launch. So here's a quick summary of what we just discussed, and we can go to questions. If you have any more questions, please use the Q&A. So crypto assets is a new form of financial, crypto assets require a new form of financial analysis. The traditional methodologies are just not enough. Blockchain data sets should be at the core, at the center of any methodology, of any techniques that you use to analyze crypto assets, because are the main indicator of investor behavior, which is a goldmine. And data science, and this is a data science play. These are not humans looking at things and trying to extrapolate strategies. Data science can find nonlinear correlations between this in this complicated data set that humans just can't. So it's definitely putting data science and advanced statistics at the in the middle of this. So this is all I have for this webinar. I would like to announce our next webinar. Here's how it's going to work. So you should register for this, because if not, our obnoxious marketing team is going to be sending you an email a day until you do so. So we're going to dig deeper into crypto asset fundamental analysis with more data science, more techniques, and even better examples. The webinar will be led by my partner and co-founder, Leonard Burr, who is incredibly insightful and one of the minds behind Intotheblock, and it's going to take place on Wednesday, August 21st. So this is a link. You're going to receive an email after the webinar. Please register, and we're going to be conducting this every 2 or 3 weeks. And every time we're going to bring you new analysis, new insights, and new ideas about how the crypto markets are playing. That's all I have. That's my contact info. You can drop me an email on my Intotheblock. I'm a very active writer on Medium, so you can contact me through there, or just contact our team at intotheblock.com and register for the beta and play with it. There is a question from Mark about the business model of Intotheblock. So there are 2 tracks, one for institutions, meaning exchanges, funds, financial companies, in which it expands from a subscription to a revenue model depending of the specific player. There is a model for retail that is going at $9.99 a month. Again, we haven't launched. You can feel free to The beta has over 700 tokens, about 8 or 9 blockchains. We're about to unveil B1. If you're more interested on learning about price, drop me an email or contact or business developer or sales team, and they will be happy to explore some options with you. We're launching with, I will say, serious institutional players as customers. So that's, we're taking our time to get this right, but the launch is gonna be something. Any other questions? I don't see anything else in the Q&A. That was 32 minutes. So I would like to thank you very much for your time. I hope to see you on the next one, Wednesday, August 31st. That is going to be even richer in terms of data than this one. And I would like to thank you again for joining and taking the time to learn more about Intotheblock and data science for crypto. Thank you very much.